Thank you, Mr. Chairman. A lot has been covered, obviously, and you know, I've been listening to this discussion of rural, and we've been able to work this through with consumer finance. And so we now have our definition at work. So, you know, give them a call. Maybe they'll say, Governor, maybe they'll work it out with you. One of the things that I want to point out, because we've been talking a lot about manufactured housing, and we're talking about real estate versus chattel lending. The difference that is hugely important to the consumer is the non-recourse nature of a mortgage versus chattel lending. And so you could, in fact, if you overburden or put too much debt on a borrower who is financing a manufactured home, you could be indenturing them for a long time. They can't simply walk away from that debt. In most states, they can't. And so we just need to be really careful as we pursue the manufactured housing, understanding that it doesn't have the same kind of characterization that mortgage lending does. So I just want to kind of put that down. I am concerned about creditworthiness, and manufactured housing plays into this, as you have said, Chris, about that, or I think it might have been you, Tom, that we begin with that lower level and then work up. We're looking at twin homes, condos, you know, apartment buildings, small first-time homeowner kind of operations that then move up. That's true for manufacturing housing. Some of my folks live there for 50 years, but many transition out to a regular mortgage and a regular home. Going back to credit scoring, one of the things that is happening now is in the world of big data, looking at algorithms and looking at not whether you paid your bill or whether you've have a bank account, or what did you buy yesterday, where do you shop. And so I want you to comment a little bit about this trend to try and analyze creditworthiness, looking at big data and algorithms and different kinds of inputs, and whether you've seen any movement in that direction, or if this is a 10-year out problem. And Mr. Woods, maybe start with you.
I think it may be the 10-year out problem. I'm intrigued by that kind of data. I think it plays into, as I say, the community banker, those relationship loans that were first made, in many cases were made because that banker knows the granddad and the dad and the uncles and their hardworking family, and they pay their bills, and it's just built into their nature. But that young person that walks in there certainly doesn't have the credit and all the other things that he would need to have a 750 credit score. One of the other things I thought interesting that we passed over running, they would allow loans at 660, but nobody's making them. They're making them at 750 and above. I defend the fact I came from some pretty humble beginnings. I would fight the fact that there are a lot of people in those lower scores that pay their bills. They pay them on time, and that's their genetic.
and an independent community banker who's been in that community, who has a relationship that goes way back, knows which family. I say this all the time in North Dakota. You could have a banker, client or customer comes in, and you look at the financial statement, it checks all the boxes. There's no way you're going to give them a loan. The guy who owns the body shop down the street, who has always paid his bills, because his community reputation, you want to give him the loan, and you don't want to be dinged for it in an examination, or you want to be able to do what you've always done in your communities. And so I don't think anyone's more sympathetic, coming from a town of 90 people, than I am about what that means for relationship banking. But I am concerned about creditworthiness. We hear this over and over again, and it's not just student debt. It is depressed wages. It is the whole 9 yards that challenge millennials and young people. And then it is a change in consumptive behaviors. Are they really looking for those loans? Are they looking to the shared economy? And how do we reach out to those folks, because we know that's also a way that they can build equity, that they can build a future. And this is a big part of solving our retirement problem as well. And so I'm going to associate myself with Senator Corker. I was on that effort last time and urged the committee chairman to give us another go at the great work that we did last Congress. I think it will help solve and analyze a lot of these problems. And so I want to thank you all, and I'm going to submit some questions for the record with the chairman's appreciation and approval. And thank you for the work that you do on your communities, and thank you for the work that you do on behalf of consumers.